Before sunrise, the harbor was already awake. Along the waterfront of New York, Philadelphia, Boston, and Charleston, wooden ships rested against crowded docks while sailors carried barrels, crates, and heavy bundles down narrow gangplanks. The air smelled of salt water, tobacco, wet rope, coffee, sugar, and molasses. Merchants stood nearby with lists in their hands, calculating how much their imported cargo would cost them before it could be offered for sale. Among the busiest buildings near the water was the Custom House. There, federal officers inspected cargo manifests and collected duties on products arriving from other countries. A shipment of British cloth, French wine, Caribbean sugar, or European metal goods could not simply be unloaded and sold. The importer first had to pay a percentage of the cargo's value to the United States government. For most Americans, this was the federal tax system. There was no annual federal income tax return. Employers did not remove federal income taxes from workers' wages. Farmers did not calculate their yearly profits for Washington. Shopkeepers did not send a portion of their personal earnings to a national tax agency. Instead, the federal government gathered much of its money at the edges of the country, especially at its seaports. This system was not an accident. It was born from one of the greatest weaknesses of the government that existed before the Constitution. Under the Articles of Confederation, Congress could request money from the states, but it lacked an effective independent system for collecting national revenue. The Revolutionary War had left the new country deeply in debt, yet the national government often depended on states, choosing to provide the money it asked for. The situation made it difficult to repay creditors, maintain public confidence, or prepare for another national emergency. When the Constitution was written, its framers gave Congress the power to impose taxes, duties, imposts, and excises. The new federal government would no longer survive only by asking the states for contributions. It could collect its own revenue and use that money to pay national debts, support defense, and operate federal institutions. But possessing the power to tax did not mean that every form of taxation was politically acceptable. Americans had just fought a revolution in which taxation had played a central role. The memory of British taxes remained fresh. Any attempt by the new government to reach directly into a citizen's home, farm, or earnings risked reviving fears of distant and abusive authority. Customs duties appeared to offer a less confrontational solution. The tax was officially paid by the importer when foreign goods entered the country. The importer normally added that cost to the price charged to merchants and consumers. As a result, Americans still carried much of the financial burden, but they encountered it through higher prices rather than through a federal collector demanding a portion of their annual income. A woman purchasing imported cloth might never see a tax bill from Washington, yet part of the price she paid helped finance the government. A family buying foreign sugar contributed indirectly to federal revenue. A merchant selling European tools passed the cost of the import duty to customers across the growing republic. The system transformed international trade into the financial foundation of the United States. One of the first major laws approved by the First Congress was the Tariff Act of 1789. Sponsored in the House by James Madison, the measure placed duties on imported goods and helped provide revenue to the new government. During the decades before the Civil War, customs duties supplied the overwhelming majority of federal receipts in most years. The man responsible for organizing much of this early financial system was Alexander Hamilton, the nation's first Secretary of the Treasury. When Hamilton entered office in 1789, the Treasury faced debts accumulated during the Revolution. Hamilton believed that paying those obligations would establish the credibility of the United States. A government that honored its debts could borrow during future emergencies, attract investment, and demonstrate that the new constitutional system was stronger than the Confederation it had replaced. During 1790 and 1791, Hamilton helped establish a revenue structure based primarily on customs duties and excise taxes. Money collected at the ports would support the Treasury and help meet payments on the national debt. The Custom House therefore became more than a warehouse or government office. It was one of the most important financial institutions in early America. Federal revenue depended on ships continuing to arrive. It depended on merchants continuing to import. It depended on Americans continuing to purchase foreign products. This created a strange arrangement. The government could collect more money when international trade expanded, but it could suffer when war, embargoes, depressions, or naval blockades interrupted commerce. Washington's financial health was connected to activity in the Atlantic ports. There was another source of money growing beyond the coastal cities: public land. As the United States expanded westward, the federal government controlled enormous territories that could be surveyed and sold. Settlers, land companies, and speculators purchased parcels from the government, creating another stream of federal revenue. Public land sales sometimes produced substantial sums, although customs duties remained the dominant source of revenue during most of the period before the Civil War. The arrangement revealed something fundamental about the early republic. The federal government was financed not primarily by measuring what individual Americans earned, but by taxing what entered the country and selling portions of the territory the nation claimed to possess. Yet these sources alone did not always satisfy Hamilton's plans. The national debt remained heavy, and the Treasury needed dependable income. In 1791, Congress approved an excise tax on distilled spirits. The tax struck the western frontier with particular force. For farmers in western Pennsylvania, whiskey was not simply a luxury drink. Grain was difficult and expensive to transport across rough roads and mountain passes. Converting grain into whiskey made it more compact, durable, and valuable. Distilled spirits could be sold, exchanged, and transported more easily than wagon loads of rye. To many frontier farmers, the federal excise tax seemed designed by wealthy Eastern officials who did not understand Western life. Resistance grew. Tax collectors were threatened. Protesters organized. Some refused to pay. By 1794, the confrontation had become known as the Whiskey Rebellion. President George Washington's administration viewed the resistance as a direct test of federal authority. If citizens could force the government to abandon a legally enacted tax through intimidation, the new constitutional system might prove no stronger than the government that had failed before it. Washington mobilized a large militia force and traveled part of the way with it toward western Pennsylvania. The rebellion collapsed without a major battle, but the message was unmistakable. The federal government now possessed both the legal power and the practical determination to collect revenue. The episode also exposed a conflict that would follow the United States for generations. Every tax created winners, losers, and political enemies. Tariffs raised money, but they also increased the price of imported goods. They could protect American manufacturers from foreign competition, but consumers might pay more. Excise taxes could provide dependable revenue, but they often fell heavily on particular products and communities. Public land sales brought money into the Treasury, but they also encouraged speculation and tied national expansion to the displacement of indigenous nations. There was no tax-free America. The country before the permanent income tax was not a country without taxation. The burden was simply distributed differently. State and local governments collected property taxes, poll taxes, and other charges. The federal government relied heavily on customs duties, along with land sales and selected internal taxes. For ordinary citizens, Washington's financial demands were often hidden inside the price of a coat, a cup of sugar, a bottle of whiskey, or an imported iron tool. For several decades, the system appeared sufficient because the federal government's responsibilities were narrower than they would later become. There was no nationwide social security system, no Medicare, no modern federal highway network, and no permanent military establishment comparable to the one Americans know today. But the apparent simplicity of the system concealed a dangerous weakness. When ships stopped arriving, customs revenue could collapse. And in 1812, as the United States entered another war against Britain, the nation would discover what happened when a government financed through foreign trade was forced to fight one of its most important trading partners. The custom houses had built the early treasury. War was about to reveal their limits. In June 1812, the United States declared war on Great Britain. The decision was driven by years of conflict over maritime trade, the forced impressment of American sailors, British interference with American shipping, and tensions along the nation's western frontier. But the war created an immediate financial problem for Washington. The federal government depended heavily on customs duties collected from foreign trade. Now, the United States was fighting the most powerful naval empire in the world. British warships blockaded American ports, disrupted commerce, and sharply reduced the flow of imported goods. With fewer ships arriving at American harbors, customs officers had fewer cargoes to tax. The revenue system that had sustained the federal government during peacetime weakened precisely when Washington needed more money for soldiers, weapons, ships, transportation, and military supplies. The contradiction was impossible to ignore. The government needed foreign trade to generate revenue, yet war had interrupted that trade. Congress responded by increasing customs duties and introducing additional internal taxes. The government placed taxes on products such as distilled spirits, refined sugar, carriages, and certain manufactured goods. It also relied heavily on loans. American banks and private investors purchased government securities, providing Washington with the money it could not immediately collect through taxation. But borrowing came with a cost. Creditors expected repayment with interest, and the government's ability to raise funds depended on confidence in the nation's future. The War of 1812 demonstrated that tariffs could finance a limited peacetime government, but they were dangerously unreliable during a major international conflict. When the war ended in 1815, customs revenue recovered. Imports returned, merchants resumed business, and American consumers once again purchased foreign products in large quantities. The emergency internal taxes were gradually removed, and the federal government returned to its familiar dependence on tariffs and public land sales. Yet tariffs were no longer seen only as a source of government revenue. They had become a weapon of economic policy. During the war, the British blockade had made imported manufactured goods more difficult to obtain. American factories expanded to meet domestic demand, particularly in the Northeast. After peace returned, British manufacturers flooded the American market with cheaper goods. Factory owners feared that these imports would destroy the industries that had grown during the war. They demanded protection. In 1816, Congress approved a tariff designed not only to raise revenue but also to protect American manufacturers from foreign competition. By making British goods more expensive, the government hoped consumers would purchase products made in the United States. The policy benefited many northern manufacturers, but it created resentment in the agricultural South. Southern states exported cotton, tobacco, and other crops to foreign markets. Plantation owners and merchants often preferred inexpensive imported goods. Protective tariffs increased the prices of those goods and threatened to provoke retaliation from countries that purchased American agricultural products. To a factory owner in Massachusetts, a high tariff could represent national progress. To a cotton planter in South Carolina, the same tariff could represent a transfer of wealth from the South to northern industry. The conflict grew during the 1820s. In 1828, Congress passed a particularly high tariff that its opponents called the Tariff of Abominations. Southern political leaders argued that the law unfairly favored one region of the country over another. South Carolina went further. Under the influence of Vice President John C. Calhoun, the state developed the theory that a state could declare a federal law unconstitutional and refuse to enforce it. In 1832, South Carolina attempted to nullify federal tariff laws within its borders. President Andrew Jackson rejected the claim. Although Jackson had often presented himself as a defender of states' rights, he considered nullification a threat to the survival of the Union. He warned that the federal government would enforce its laws and supported legislation authorizing military action if necessary. A compromise tariff eventually reduced tensions, but the crisis revealed how deeply federal taxation had become connected to regional power. The argument was not simply about the percentage charged on imported cloth or iron. It was about who benefited from the Union, who carried its financial burdens, and whether a state could resist federal authority. Throughout the following decades, tariffs remained the central source of federal revenue. Customs officers continued collecting money at ports, while the sale of Western land brought additional funds into the Treasury. For many years, this system generated enough money because the federal government remained relatively small. But the country was changing rapidly. Railroads stretched across states. Cities expanded. Factories multiplied. Immigration accelerated. Federal territories moved toward statehood. Political conflict over slavery intensified. Then, in 1861, the nation entered the most expensive crisis in its history. The Civil War required money on a scale the federal government had never previously imagined. When Confederate forces fired on Fort Sumter, President Abraham Lincoln called for troops. The Union had to recruit hundreds of thousands of soldiers, provide uniforms and food, manufacture weapons, construct ships, move armies across vast distances, and support a war that no one could confidently predict would end quickly. Tariffs alone could not pay for it. The Union government increased import duties, imposed excise taxes, borrowed enormous sums, and issued paper currency known as greenbacks. But even these measures were not enough. For the first time, Washington turned toward a broad federal tax on personal income. In 1861, Congress approved an income tax as part of an emergency revenue law. The initial measure was difficult to implement and was soon replaced by a more detailed system. The Revenue Act of 1862 created a tax that applied different rates according to income. Americans earning below a specified threshold paid nothing. Those with higher earnings paid a percentage of their income to the federal government. This was a revolutionary change. For the first time, Washington was no longer relying primarily on what Americans purchased or imported. The federal government was asking certain citizens to report how much they earned and surrender part of that income directly. Congress also created the Office of the Commissioner of Internal Revenue, the ancestor of the modern Internal Revenue Service. Federal assessors and collectors entered communities across the Union. They gathered information, calculated obligations, and enforced taxes on income as well as numerous products, businesses, licenses, and transactions. The new system reached deeply into economic life. Taxes were imposed on manufactured goods, alcohol, tobacco, financial documents, inheritances, and professional activities. The Union's Internal Revenue Network became one of the most extensive administrative operations the federal government had ever created. Still, the income tax affected only a minority of Americans. Most workers earned too little to meet the taxable threshold. The burden fell primarily on wealthier citizens, professionals, merchants, and successful business owners. This helped supporters defend the measure as a fair contribution from those most capable of financing the preservation of the Union. But many Americans remained suspicious. Opponents argued that an income tax invaded personal privacy. To calculate the tax, the government had to know how much someone earned. Citizens could be required to disclose profits, salaries, rents, and investments to federal officials. That was very different from paying a higher price for imported fabric without ever meeting a tax collector. The Civil War income tax also raised constitutional questions. The Constitution required certain direct taxes to be apportioned among the states according to population. Congress designed the wartime income tax to avoid that requirement, but uncertainty remained over how such taxes should be classified. During the war, emergency necessity outweighed many objections. The Union needed money. By the time Confederate armies surrendered in 1865, the federal government had developed financial powers that would have shocked many Americans from the early republic. It had issued national currency, established a national banking system, sold massive quantities of bonds, collected internal taxes, and taxed personal income. But victory did not make the wartime tax permanent. After the war, political pressure to reduce federal taxation intensified. The income tax remained temporarily in place, but its rates were lowered. Congress allowed it to expire in 1872. The nation returned once more to a system dominated by tariffs and excise taxes. For many Americans, the end of the income tax confirmed an older belief. Direct federal taxation of personal earnings was acceptable only during an extraordinary national emergency. In peacetime, the government should return to the custom house. Yet post-war America was no longer the modest commercial republic of George Washington's generation. The railroads connected distant regions. Corporations grew larger. Industrialists accumulated fortunes previously unimaginable. Steel, oil, banking, and manufacturing created a new class of extraordinarily wealthy Americans. At the same time, the federal government continued to collect much of its revenue from tariffs and excise taxes. These taxes were built into the prices of goods. A factory worker, A farmer and a millionaire might all pay the same federal tax hidden inside a pound of sugar or an imported household item. But the cost consumed a much larger share of the worker's income than the millionaire's wealth. Critics began describing the system as regressive. The government, they argued, was taxing consumption while leaving enormous private fortunes largely untouched. Farmers in the South and West complained that protective tariffs increased the prices of manufactured goods. Urban workers faced rising living costs. Reformers claimed that the federal revenue system favored industrial corporations and wealthy investors. Meanwhile, the government sometimes collected more money than it immediately needed. The Treasury accumulated surpluses while political leaders argued over whether tariff rates should be reduced. Manufacturers resisted major reductions because protective duties shielded them from foreign competition. The federal tax system had become trapped between two purposes. Tariffs financed the government, but they also protected powerful industries. Reducing them could lower consumer prices, but it could also threaten American factories and eliminate the government's main source of revenue. By the 1890s, a growing political movement demanded a different solution. Instead of relying so heavily on taxes hidden in the price of ordinary goods, reformers wanted Washington to collect money from the fortunes and incomes created by the new industrial economy. The income tax, once justified as a temporary weapon of civil war, returned as a demand for economic fairness. But the wealthiest Americans had no intention of accepting it without a fight. And this time, the greatest obstacle would not be rebellion in the countryside or resistance at the ports. It would be the Constitution itself. By the end of the 19th century, the United States had become one of the most powerful industrial nations on Earth. Railroad lines crossed the continent. Steel mills illuminated the night sky above cities like Pittsburgh and Chicago. Oil refineries expanded, banks grew more influential, and corporations accumulated wealth on a scale that would have seemed impossible only a generation earlier. This era produced extraordinary fortunes. Men such as John D. Rockefeller, Andrew Carnegie, J.P. Morgan, and Cornelius Vanderbilt became symbols of American industrial power. Their supporters described them as builders who had modernized the nation, created jobs, and connected distant markets. Their critics called them robber barons. While industrial leaders lived in mansions and controlled enormous corporations, millions of workers faced long hours, dangerous factories, unstable employment, and low wages. Farmers in the South and West struggled with debt, falling crop prices, and expensive railroad charges. Many Americans believed the federal tax system made the inequality worse. Washington still obtained much of its revenue from tariffs and excise taxes. Tariffs were collected from importers, but their costs were often passed to consumers through higher prices. Excise taxes on products such as alcohol and tobacco also affected ordinary households. A wealthy banker and a factory worker might pay similar taxes when purchasing the same product. But the amount represented almost nothing to the banker and a meaningful sacrifice to the worker. Reformers argued that the government was taxing what people needed while ignoring what the richest Americans earned. The demand for a federal income tax grew particularly strong among farmers, labor activists, Southern Democrats, Western populists, and progressive reformers. They believed that citizens who benefited most from the industrial economy should contribute more directly to the government that protected property, enforced contracts, built national institutions, and supported commerce. In 1894, Congress attempted to answer those demands. The Wilson-Gorman Tariff Act reduced some tariff rates and introduced a federal tax of 2% on incomes above $4,000. At the time, that threshold was high enough to exclude the vast majority of American families. Supporters presented the measure as modest and fair. It was not designed to reach ordinary workers. It targeted a relatively small group of affluent citizens. But wealthy taxpayers and financial interests challenged the law in court. The legal battle reached the Supreme Court in the case of Pollock v. Farmers, Loan and Trust Company. In 1895, the court struck down key parts of the income tax. The justices ruled that taxes on income derived from property, including rents and investments, were direct taxes. Under the Constitution, direct taxes had to be apportioned among the states according to population. That requirement made a practical national income tax almost impossible. Apportionment could produce bizarre results. A poor state with a large population might be required to contribute more than a wealthier state with fewer residents. The tax would no longer be based simply on how much income individuals earned. To supporters of the income tax, the decision seemed to protect wealth through constitutional technicalities. To opponents, the court had defended the original limits placed on federal power. For years, the issue remained unresolved. Then, the progressive era transformed American politics. During the early 20th century, reformers demanded stronger regulation of corporations, safer working conditions, greater political accountability, and changes to a government they believed had become too closely connected to powerful business interests. The income tax became part of this larger struggle. It was not merely a question of revenue. It was a question of who should carry the cost of the American government. In 1909, President William Howard Taft faced growing pressure from members of Congress who wanted to restore the federal income tax. Taft personally favored a more cautious approach. He supported a tax on corporate income and proposed a constitutional amendment that would clearly authorize Congress to tax individual incomes without apportioning the revenue among the states. Some conservative politicians believed the amendment would never be ratified. They misjudged the country. Congress approved the proposed amendment in 1909 and sent it to the states. Over the next several years, state legislatures debated whether Washington should receive this new power. Opponents warned that the tax could become intrusive and dangerous. They feared that once the federal government gained the authority to tax income, rates would rise and the system would reach deeper into private life. Supporters responded that the existing system was already unfair. Tariffs placed much of the burden on consumers. The wealth generated by corporations, investments, and industrial fortunes remained comparatively protected. An income tax, they argued, would distribute the responsibility according to a citizen's ability to pay. On February 3, 1913, Delaware became the 36th state to ratify the amendment, providing the necessary 3/4 majority. The 16th Amendment became part of the United States Constitution. Its language was brief, but its impact was enormous. Congress now possessed the power to collect taxes on incomes from any source without dividing the total among the states according to population. A constitutional obstacle that had blocked the 1894 tax was gone. The timing was remarkable. Only weeks later, Woodrow Wilson entered the White House. Wilson and the Democratic majority in Congress wanted to reduce protective tariffs, which they believed raised consumer prices and favored powerful manufacturers. But lowering tariffs meant reducing the government's traditional source of revenue. The new income tax power offered a replacement. In October 1913, Wilson signed the Underwood Tariff Act, which substantially reduced many import duties and established a federal income tax under the authority of the 16th Amendment. The first permanent income tax looked very different from the modern system. It did not affect most Americans. Individuals received a generous exemption before paying any tax. The basic rate was only 1% on taxable income, with additional surtaxes applied to very high incomes. Only a small fraction of the population earned enough to owe federal income tax. For the average factory worker, farmer, or shopkeeper, the new tax initially changed little. There was no large Internal Revenue Service processing returns from nearly every household. There was no federal income tax deduction removed from each paycheck. Most citizens remained outside the system entirely. The tax had been designed primarily as a levy on the affluent. Yet, the principle behind it represented a profound transformation. Before 1913, the federal government had usually financed itself by taxing trade, consumption, land transactions, and specific products. After the 16th Amendment, Washington possessed a stable constitutional mechanism for collecting money directly from the incomes of individuals and businesses. The government was no longer financially dependent on the ships entering its harbors. It could now reach into the economic life of the nation itself. At first, the income tax remained small because the federal government remained limited by modern standards. Then Europe went to war. When the United States entered World War I in 1917, military spending increased dramatically. Congress lowered income thresholds, raised tax rates, expanded the number of citizens required to pay, and placed greater burdens on corporations and wealthy individuals. The pattern repeated during World War II on an even greater scale. The federal government needed to finance millions of soldiers, enormous military production, global operations, and the industrial mobilization of the entire country. Income taxation expanded from a tax paid largely by the wealthy into a mass system affecting ordinary Americans. Payroll withholding made it possible for the government to collect taxes throughout the year rather than waiting for citizens to make a single annual payment. The modest tax of 1913 became the financial foundation of the modern federal government. Its revenue helped support national defense, infrastructure, regulatory agencies, public programs, scientific research, social security, and countless other responsibilities that earlier generations had never expected Washington to assume. But the fears expressed by early opponents never disappeared. Americans continued debating whether income taxes were too high, whether the tax code was too complicated, whether the wealthy paid enough, and whether the government used the money responsibly. Those arguments still shape American politics. Every April, millions of citizens confront the legacy of the decision made in 1913. They calculate wages, investments, deductions, business profits, and credits. Their relationship with the federal government becomes visible in numbers printed across tax forms. Yet for most of American history, such a ritual did not exist. The early republic survived by taxing imported goods at its ports. It sold public land, imposed excise taxes, and borrowed during emergencies. Its financial system reflected a nation with a small central government and an economy tied closely to Atlantic commerce. War repeatedly exposed the weaknesses of that arrangement. Industrialization exposed its inequality. Constitutional reform finally replaced it. The income tax was not introduced because the United States had previously operated without taxes. It emerged because the older taxes could no longer support the government Americans were creating or satisfy growing demands that wealth should carry a larger share of the national burden. Before 1913, the cost of Washington was often hidden inside the price of sugar, cloth, whiskey, tobacco, and imported tools. After 1913, that cost became personal. The federal government no longer waited for revenue to arrive aboard a ship. It could collect it directly from the prosperity of the American people.